Washington, D.C. As it announces what is anticipated to be another significant three-quarter-point boost in its benchmark interest rate, its fourth in a row, the Federal Reserve may hit a turning point this week. Officials from the Fed will probably have a contentious discussion on whether it would soon be time to scale back rate increases, which are meant to contain the worst inflation in 4 decades but are also increasing the risk of a recession. Following the Fed's most recent meeting, Chair Jerome Powell may have hinted at a future shift to slower rate increases during a news conference on Wednesday. This would allow regulators some time to evaluate how the price increases would affect people. The housing sector in particular has suffered because of the rising loan charges. According to mortgage buyer Freddie Mac, the average rate on a 30-year fixed-rate mortgage, which was only 3.14% a year ago, reached 7% last week for the first time since 2002. For 8 consecutive months, fewer people are buying existing homes. Fed officials have emphasized that they must considerably hike rates in order to control inflation, which has put millions of consumers through hardship. In the 2018 congressional elections, Republicans' main line of attack against Democrats is now high inflation. However, several economists have suggested that the Fed soon think about slowing down the sharpest rate hikes since the early 1980s. The benchmark short-term rate set by the Fed is currently 3% to 3.25%. By the end of the year, policymakers said they would increase it by another 1.25 percentage points in September. According to that schedule, the rate may increase by 3/4 of a point on Wednesday and by a half point in December. The Fed is worried that the financial markets may believe it would soon cease raising interest rates completely and perhaps consider cutting them next year if it indicates it might loosen up on its credit tightening. The rise in stock and bond prices would undermine the Fed's attempts to curb the economy. Another possibility is that policymakers could plan an additional quarter-point rate increase early in the following year when they revise their economic projections in December. This would demonstrate their commitment to containing inflation, which peaked at a painful 8.2% in September. The fact that some early indications point to an inflation decline beginning in 2023 is one reason the Fed may start easing up soon. Due to rising costs and expensive loans, consumers are beginning to cut back on their spending. Ocean freight costs have dropped 67% in the last year, eliminating supply chain bottlenecks, which implies fewer shortages. Wage growth has reached a peak, and if this is followed by reductions, inflationary pressures will be lessened. The president of the Federal Reserve Bank of Minneapolis, Neel Kashkari, has stated that we need to see meaningful progress in core inflation and services inflation, and we are not seeing that yet. Core inflation is seen as a good indicator of underlying price pressures because it does not include volatile food and energy prices. Some have struck more upbeat notes. Inflation is anticipated to decline soon for a number of reasons, including price reductions by retailers to get rid of excess inventory, according to Fed Vice Chair Lael Brainerd. She asserted that the Fed will be better able to assess how the economy is responding to rate hikes and how many more may be necessary by going forward gradually. The moment has come to start about retiring, according to Daily. The majority of indications of declining inflation have been found in data sources from the private sector, such as websites that track rent and housing costs. According to some economists, Fed officials will need to give these sources more weight in the upcoming months. For the first time this year, according to the data company Apartment List, rentals in new leases decreased from August to September. Even over the previous 12 months, the nonetheless significant 6.8% increase in rentals was considerably smaller than the 17.1% 12-month increase that was observed a year before. Though it might take a year or more, the downturn in house prices will eventually be reflected in the government's figures. Numerous economists believe that before then, the Fed will need to take those lowering home costs into consideration. Nationwide senior U.S. economist, Kathy Bostjancic, stated that the Fed policymakers need to be looking through the front windshield, not the back, and be more careful with their rate hikes as interest rates reach levels that impede growth and real-time data suggests slowdowns in rents and wages. According to TD Ameritrade economists, these actions contributed to anticipation that a dovish tilt is approaching for all major central banks.